Welcome to Compounding Academy. In this session, we're diving into Experian, a company you've almost certainly interacted with, whether you realized it or not. Experian is the global leader in consumer credit data. But this isn't just a story about credit scores, it's a story about data, trust, and long-term compounding. We'll break down what makes Experian a high-quality business, from the structural tailwinds behind its growth to the moats that protect it, and the financial discipline that drives strong returns year after year. Let's explore the drivers behind one of the most powerful data businesses in the world. This is a business riding two powerful waves: the growing demand for data and a regulatory environment that increasingly depends on it. Let's look at the forces shaping the industry and why they set the stage for long-term growth. The world runs on data, and the demand for it keeps rising. At the same time, regulation is tightening, with governments pushing for greater transparency, accountability, and consumer protection. For companies like Experian, that combination creates a long-term, structural tailwind. This isn't a short-term trend. It's a rewiring of how modern economies make decisions. Businesses today face a simple equation: better data equals better decisions. That's why demand for analytics, fraud prevention, and real-time credit insights continues to grow, not just in finance, but across insurance, healthcare, even hiring. And with regulation evolving fast, companies are under pressure to prove they're making fair, informed, and compliant decisions. That pressure flows straight to firms like Experian, whose data is no longer just useful, but essential. Now let's zoom in on Experian. In a world built on data, they sit at the heart of some of the most important decisions: credit, identity, fraud, and trust. Let's dig into what makes them a true compounding machine. At its core, Experian is in the business of turning data into decisions. On the business side, it offers credit databases and advanced analytics, helping banks, insurers, and employers assess risk, prevent fraud, and make smarter calls. On the consumer side, it helps people understand their credit, monitor their identity, and improve their financial lives. This dual model, B2B and B2C, creates a powerful feedback loop. More data strengthens the product, and stronger products bring in more users and use cases. So what makes Experian a long-term compounder? Three things stand out. First, it's proprietary data, built up over decades through acquisitions, integrations, and partnerships. This isn't just information, it's a deep, structured, and highly regulated asset base that competitors can't easily replicate. That creates real stickiness and long-term advantage. Second, scale. With global reach and high fixed cost leverage, Experian can serve more customers at lower incremental cost and reinvest the difference. And third, innovation. Experian keeps building smarter tools on top of its data. Tools that turn raw information into actionable insights. That helps customers make better decisions and keeps Experian essential to their day-to-day operations. In data, scale matters, and the gap is widening. Experian isn't just ahead in size, it's also more globally diversified than its peers, with roughly a third of revenues coming from outside North America. That gives it exposure to faster-growing markets and regulatory tailwinds. Meanwhile, smaller or single-region players struggle to keep up with the pace of innovation, compliance demands, and customer expectations. Over time, the leaders with scale, data, and distribution are likely to keep pulling further ahead. This is what we like to see: a clear upward trend. Over the past decade, Experian has delivered consistent, visible revenue growth. The only dip you see here isn't a slowdown. It's a strategic divestment of a non-core marketing business. That decision let Experian double down on higher-margin, data-rich services. A classic move for a disciplined compounder. This kind of revenue chart is exactly what we look for. A 6% compound annual growth rate over 15 years might sound modest, but the shape of the curve tells the real story. Since 2016, growth has accelerated. That's after Experian refocused the business on core data and decisioning capabilities. A deliberate shift that's now driving stronger compounding. It's not just about the number, it's about the trajectory and what's behind it. The industry itself is set to grow fast, over 11% a year, according to some estimates, driven by digitization, rising credit penetration, and increasing demand for identity and fraud solutions. But here's what stands out. Experian is positioned to outgrow even that strong baseline. Why? Because it's not just riding the wave, it's shaping the market. With deeper data, stronger products, and a broader global footprint, it's gaining share as the entire pie expands. This chart gives us another signal of quality. Consistent margins. The lighter bars represent gross margin. That's revenue minus the direct cost of delivering the service. The darker section shows operating margin. What's left after running the business? What stands out here is how stable both have been over time. That tells us two things. Experian has pricing power, and it runs a lean, efficient operation. This kind of margin profile is exactly what we look for in a high-quality compounder. If you want to understand whether a business is truly compounding value, this is the metric to watch. Return on invested capital tells us how well a company turns every dollar of investment into profit. The higher and more consistent it is, the more value is being created over time. Experian scores well here, with strong, stable returns. But these numbers actually understate the strength of the business. Because of years of acquisitions, there's a lot of goodwill baked into the balance sheet. Strip that out, and return on tangible capital is significantly higher. That's the real story. A capital-light, high-return model, quietly delivering strong compounding under the surface. This chart shows two key indicators of financial strength. The blue bars represent net debt to EBITDA, a measure of leverage. Anything under 2x is generally considered conservative, and Experian has consistently stayed in that safe zone. That gives them resilience during downturns and flexibility to invest or acquire when opportunities arise. The red line tracks free cash flow as a percentage of net income. This tells us how well profits convert into actual cash, and Experian excels here, regularly delivering well over 100%, with conversion as high as 200% in some years. High cash conversion and modest leverage is a powerful combination. It means this business not only earns well, it keeps what it earns. Even the best compounders face risks, and it's important to be clear-eyed about them. First, cybersecurity. Experian holds highly sensitive data, and any breach could damage trust and lead to regulatory penalties. The Equifax incident a few years ago was a wake-up call for the entire industry, and has likely made firms like Experian even more vigilant. Second, regulation. While evolving regulation is generally a tailwind for Experian, driving demand for its services, it also brings risk. Stricter rules around data privacy or consent could add cost or restrict how data is used in certain markets. And third, competition. Fintechs and new data players are pushing into the space, especially on the consumer side. So far, Experian's moat has held, but this is one to watch. These are the numbers to watch if you are following Experian. First, organic revenue growth. Experian is targeting 6 to 8% per year. For a business of this scale and maturity, that's impressive. Second, margin expansion. They aim to grow operating margins by 30 to 50 basis points annually. That shows efficiency gains, even as they keep investing in innovation. And third, CapEx. Capital spending is expected to fall from 9% of sales to 7% by 2029, reflecting the scalability of their platform. Track these KPIs over time and you'll get a pretty good read on how well the compounding engine is running. This is the full picture. Experian scores a 7.8 out of 10 on our quality framework, which puts it firmly in high-quality territory. What drives that score? Strong visibility, thanks to recurring revenues and predictable demand. Powerful competitive strengths, built on data moats and global scale. And excellent financials, with a solid balance sheet and industry-leading cash conversion. If there's a weaker point, it's resilience, mainly due to regulatory and cybersecurity risks. But overall, this is a business with serious staying power. It's not just a good company, it's one built for long-term compounding. To sum it up, Experian checks the boxes we care about most. It owns proprietary consumer data that's nearly impossible to replicate. It reinvests in innovation to stay ahead, and it benefits from economies of scale that drive high incremental margins. This is a business with strong fundamentals, powerful moats, and a track record of steady compounding. In short, Experian is a high-quality company, and one that deserves a spot on any long-term investor's focus list. If you've enjoyed this breakdown and want a clear visual summary, you can download the full one-pager at compounding-academy.com. It brings everything together, from financial metrics to competitive positioning, in a single snapshot. It also includes our quality score, which reflects our proprietary framework for assessing long-term compounders. And while we don't include valuation in these slides, to keep them timeless, we do update our valuation views regularly, and that's something we reserve for paid subscribers. If you enjoyed this overview, don't forget to subscribe for more concise takes on high-quality companies. Like and share if you found it useful. It really helps us grow. And for more deep dives, head over to compounding-academy.com